All right, everybody, welcome to Chapter 19. Chapter 19 is probably one of my favorites, right, for the balance of the book. There's a whole class on managerial accounting, and managerial accounting is going to be a large part of what some of you all will do if you join the accounting field. And I just want to kind of separate a little bit out now between financial accounting and managerial accounting. Financial accounting, we follow rules. We follow GAAP, generally accepted accounting principles. And really the hallmark of financial accounting is that we know internal our financial situation, but external, we only share it at a certain aggregate level. So for example, I know I might be losing money every time I sell to customer 1, 2, 3, 4, but I will at a very high level aggregate all my sales for everybody, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I will aggregate my sales and say, hey, public, I'm going to sell, here are my total sales. They never, ever, ever will see the breakout of any individual customer. That's all internal information. We have to follow GAAP, right? Generally accepted accounting principles, and that's our hallmark, right? We follow the rules, and the reason we follow the rules is because if we follow the rules and everybody else follows the rules, then the investors can make honest assessments of what which company to invest in, who's better, who's more efficient, who's more profitable, who they feel have a better life as far as what the company is going to do, really generate the most profit in the long run. So financial accounting is really outwardly facing. We only give the public aggregate information. Internal, we know it. It's really just for the most part private, right? We do the analysis inside. We follow rules, and that's what the whole point of financial accounting is. We follow rules. Inside of financial accounting, you can do private and public. Public accounting, what they traditionally think of as like the big CPA firms, or even small or mid-sized CPA firms. It used to be Arthur Andersen, KPMG, those guys, your big ones you hear a lot about. I didn't go that route. Just a little personal about me. You have to do a lot of traveling when it comes to work with big CPA firms, probably 200, 250 days of the year. Just wasn't my thing. So I worked in just as far as public companies, but not with CPA firms. Philips Electronics, Coke, Mars, Dueler, and of course, right, now where I am as far as the CFO. The pay's about equal, right? Just to be honest. I mean, if you enjoy going and traveling, then the route of going to being a CPA and working with CPA firms is perfect for you. If you kind of hate traveling like me, then it's probably not the best thing for you to do. But with financial accounting, it's external. You work with stockholders, creditors, regulators. It's general purpose. We follow rules. We prepare financial statements. It's a preparation of the income statement, balance sheet. It's the normal financial statements that we've talked about inside of Principles 1. And it's always aggregated. At a very high level, people see what the company is. Managerial accounting, though, on the other hand, is all internal. With the managerial accounting, it's me going through and saying, what do I need to do to make the company profitable? My analysis, anything, it's special purposes. It's specific for projects. It's all internal reporting. If I can go through and identify opportunities. So can I have people work less overtime because of I'm going to stagger their time? Absolutely. Is there a way that I can get more product on a truck? All those type things fall in the big bucket of managerial accounting. It's fun, right? It's something where you get to work with operations. It's very detailed. You work with every level of the business. You work with operations. You work with customer service. I mean, it's basically you work with everybody, and you're driving the business forward. And that's always something that kind of always excited me. It's always about the business. One thing as you all interview, people love the concept of being a co-pilot for the executive team. You're a co-pilot, right? Your job is to go through and just do and to help drive the business, right? If something happens, you're able to fly the company. You know enough about it. You're that business partner. So a couple of key words to kind of throw out there and use. But managerial accounting, though, greatest thing ever, pure side note. So I'm going to talk a little bit, just purely off script, and we'll touch on the book on a few things that we do, but just want to kind of give you some of my own experiences, the way I've approached things, and just make this more just a pure fun lecture as opposed to anything too much in detail. So for the most part, you're going to work, some of you all will work in manufacturing companies. Manufacturing companies, they make stuff, right? So when I'm a manufacturing company and I specifically look at inventory, I can have 3 types of inventory. I will have raw materials, I can have work in process, and I will have finished good inventory. Raw materials is when I'm buying the core pieces. If I think about me making a pencil, the graphite, the wood, the eraser, all those are raw materials. It's what it is. It's the core. It's all the piecemeal parts that have to be pulled together. Traditionally, when you're buying stuff in a raw material state, you buy a lot of it. Of course, economies of scale that we've probably talked about in your economics class. The more you buy, the cheaper it's going to be. One thing I do encourage you all to do, as far as for who want to get more on their managerial side, is to feel free to negotiate. Your job as a finance person, you work with your procurement team. It's okay to negotiate with other outside vendors. Say, look, hey, I can get it for $10 here. I like you better. You're a greater vendor. You give me great quality. Can you do it for $9.80? Don't get greedy, right? Just a little bit. You can negotiate in coordination with procurement because your job as a finance person is drive the business forward. You're driving the business. You're cutting cost, whatever it may be. But for raw materials, you just buy a lot of them. They come in, but they're just raw materials, right? You can't do anything with them. Work in process, of course, work in process is a pencil that's been started, but it's not finished. I might have the lead inside. I might have it painted yellow, but it doesn't have the eraser. When something is in a work in process status, I can't sell it. I can only sell finished goods. And that's my third bucket. Is finished goods. And a finished goods inventory that has been completed. Everything is done to it. It's ready for sale. And once it is in a finished good status, I can sell it. We have a great incentive by the time I get a raw material in to get it converted to a finished good, because keep in mind, if I can't sell it, I'm not able to sell it for, not get the revenue. I'm not able to get the profitability from selling it for more than it costs me to make. So I have a very high incentive to, once the raw materials get in, convert it into a finished good as quickly as we can, because, like I said, inventory that you buy, right? If you buy inventory, you've got 2 journal entries. You're either going to have a debit to inventory and credit AP, which means you're getting your inventory but incurring a liability. Liabilities are necessarily bad because you have to pay them back, but also if companies are really keeping an eye on your balance sheet, they say, look, you're out of compliance. Or debit inventory, credit cash. And that means you've got the inventory, but your cash is being held up. You've already paid the cash. You can't do anything with it. You can't get that cash out until you actually sell it. So let's keep that in mind. So our job is to get from inventory with the raw materials once it comes in, all the way to really to help nudge it along the best that we can. When you have material coming in, you should always do an incoming inspection. Now, incoming inspection can be anything from, when it comes in, somebody, either a finance person or an operations person, they're doing a couple of things. One, they're comparing the quantity that is showing on the bill of lading that the vendor sent to us. And okay, I sent you 10,000 pieces with the original purchase order that we have in place that said, hey, I want to buy 10,000 pieces. Because we want to make sure that we're getting what we're supposed to. Right? And if we have a deviation, it's totally fine. We just have to be able to identify it and make sure they know they're not doing anything. Just, sometimes people make mistakes. It happens. But we're also looking at the quality of the incoming material. So let's just think about, if I'm, the same example I had before, right? I'm bringing in material for pencils. So when I bring the pencil in, that base pencil, that wood for that pencil, it's going to have a certain tensile strength, right? So if I bend it a little bit, it's not going to break, right? So it's going to have a certain tensile strength. If we get it, we bend it, same tensile strength, we bend it, same ease of use, and it snaps, we have to send it back, right? Because that material will not be useful to us, because what that's going to do is that we're going to have a lot of problems that if we would use it, take it all the way through to start to finish, people are going to be mad, right? Because their pencil's breaking too easy. And they're going to come back to me and say, look, I need my money back. Okay, so what have I done, right? I've incurred a labor cost, I've paid for the material's caught into it, and I've lost my margin, and more than likely I've irritated the customer, which we never really want to do. So with a pencil coming in, we're looking for, in this case, tensile strength. What else are we looking for? Well, we're looking for color. Let's pretend the pencils are yellow, right? Yellow is a whole big wide spectrum, if you think about it, right? I can have really, really bright yellow. I can really have a yellow which is closer to orange. There can be huge varieties inside of it. And it's basically what we're doing. We establish a standard. We say, hey, vendor, I want my yellow to be yellow 1, 2, 3, 4. And just so you know, in colors, we do have the ability to be very precise on what the color composition is, what color we want them to send to us. It's not really just 1, 2, 3, 4, 5, but just as far as just a simple way to explain it. We'll call it 1, 2, 3, 4, 5. And we allow them a certain tolerance. So with inside that color 1, 2, 3, 4, 5, it could be one standard deviation above or below, and it's still basically nobody can visibly see. But let's pretend I've got color 1, 2, 3, 4, 5, but they send me really orange, yellow orange. People will see it, people will hate it, they'll say, hey, something's different. No value, right? I can't use it. So I'm looking at the strength of it. I'm looking at the composition. I'm looking at the color. I'm looking at anything that might cause me either production issues or when I try to sell it, the customer's not going to like it and it's going to either be defective or just not attractive in general. And what I do in those cases, if we identify it, first thing I do, I go back to the vendor and say, vendor, here's my problem. How do you want to make me whole? I normally suggest that if it's something that I can fix, I'll go through and give them a quantity and say, look, I can fix it for $10,000. And the way I'll calculate that is I'll take the number of associates that it will take to work on it, extend that out by their pay, plus 15% markup because of benefits. The paint they would have to end up using in order to be able to make a color, the electric, of course round up a little bit too, just because we can. And I'll say, vendor, I can do this for you. I won't send it back to you. Cost you $10,000. Issue me a credit memo. Give me a credit back for $10,000. I'll take care of it. We won't bother you again. Most of the time they'll do it. But for the example, the one I gave you before on the tensile strength, there's nothing I can do, right? If you just bend it a little bit and it snaps, I can't do it, right? There's just absolutely nothing I can do when it comes to that. I can't do anything. So in those cases, I will have to go back through and send it back to the vendor. And what we do is we create something called an RMA, Return Material Authorization, RMA. Return Material Authorization, what it does, when we bring material in, I record it in inventory. When I do the RMA, Return Material Authorization, that is relieving inventory, removing it from inventory, and basically putting the title back to the vendor and saying, vendor, I can't do anything with it. I'm not going to pay you for it. Don't come ask me for money for it. I'm doing the return material authorization. It's your problem. Send me what I ask for. It's really all we can do when it comes to material, right? If I can fix it and I'll charge them for it, I'll charge them for it, right? Because keep in mind, right, when I establish a price, a sales price, I do it based upon here's how much time, money, and effort it's going to cost me, and anything outside of that, anything more, is going to be able to eat away at our profitability. And as accounting and finance people, we love our profitability. I mean, that's what we do. We drive the business forward. So we're kind of return material back. Material is one of the biggest components. If you think about in general, material is probably about 20% of, in general, of any, basically when I look at the P&L. Material cost is about 20%. If I look at material as a percentage of sales, it's about 20%. It's a big number. We look for waste. We look for anything where it's being inefficient. If people are throwing away material they shouldn't, let's pretend I need this much room for a pencil. If somebody's going back through and taking a piece this long and cutting only 2 pencils and they get really 3 out of it, well, that little sub part, it's a waste. Right, it's a loss. It's if I can stop that loss in any way, that's exactly what I need to do, because if I have a loss, it's a P&L impact, right? Everything is, we want to be as efficient as we possibly can. materials like super really fun. So I definitely encourage you all to go through and do some research as far as like the material cost of it. We talked in the last video about cycle counts. We do a lot of cycle counts, but good material quality is going to be your key to having a good product. If you have bad material, you're going to have a bad product. Nothing you can do about it. You'll either have more waste on the manufacturing floor, or you're going to have disappointed customers, and we don't want any of those type things. So it's kind of material. The next thing we want to talk about is labor, right? Labor, of course, is just when we talk about labor, we think about it in two terms: direct labor and indirect labor. Direct labor is labor that is directly associated with a finished product. So that's going to be, if I have 5 people working on a line, I have them work 8 hours a day, I pay them $10 a day, that is direct labor. Simple, easy math, because I know how many people I have on the line, I know how many hours in general they work. Whether I can assign it to a job or not, it doesn't always matter. I'd love to, but realistically we can't sometimes. But I know how much I pay them, so I can easily calculate my direct material cost. My direct labor cost. Indirect labor is, of course, just the labor associated, which are indirectly associated with the finished product. And that is your frontline managers, your supervisors on the floor. It's people who don't necessarily work on the product, but they have that role in getting it out the door. Your finance people, your customer service, your CEOs, your CFOs, they are not part of your indirect labor. They fall inside the line called of, if you think about the P&L, inside of expenses, specifically SG&A. Sorry, it's really G&A for the most part, anyway. But it's not part of your indirect labor. Supervisors, they're part of your indirect labor. They're the people who really get the product out. One thing that I want you all to really focus on is, as you're accounting, focus on overtime. What you're going to see is you're going to see a lot of companies spend a lot of money on overtime. And sometimes it's necessary, sometimes it's not. One KPI that I always encourage you all to do is look at your production volume in relation to overtime. Now, what you would expect to see, if my production volume is going up, I can expect that I'm going to have more overtime, right? I'm making more product, overtime should be more, kind of makes sense. But if I see on the flip side, if my production volume is flat, but my overtime is going to go up, well, then that's going to require a little bit more research. Maybe it's something you don't know. It's okay to ask questions. One of the most important things I want you all to learn out of the class is always ask questions. Whether it's me, whether it's, at work, ask questions. Because it's the only way you learn. Because what you find sometimes is that people are just inefficient, right? They have their friends. Supervisor may love people and just want to give them money because it's not really their money, right? Sometimes when it's not their money, they can do anything they want with it. Or if you see the same thing, hey, production volume is flat, overtime's going up. Look and see if people spend a lot of vacation, right? Because maybe what will happen is that people are on vacation. We don't want to hire temporary associates. Maybe that's why it's overtime. You don't know until you ask. That's really what it comes down to. You don't know until you ask. And it's okay to ask. I always want you to ask. And if anybody's ever offended by when you ask a question, they shouldn't be, because that's your job as finance people to ask questions. And that's what I want you to do. But spend a lot of time on labor. Labor cost is crazy, crazy, crazy important. If you think in general, labor cost is usually 30% of your total sales. It's very, very expensive because people are expensive. Traditionally, whatever you're paying for a person, as you do your budgeting, your analysis, bump that up 15% because you have to pay for their benefits, 401k, dental, basically whatever, right? You're having to incur an additional cost associated. The temporary labor, people, I'm always necessarily torn when it comes to temporary labor. On one hand, temporary labor it's a good thing because you're able to get somebody in very quickly, right? If you go to a temp labor group, said, hey, I want somebody who can use a saw, then they'll probably send me somebody within about 3 hours who can use a saw. That's great. On the flip side of it, temporary labor companies usually have a 35 to 40% markup. So if I'm paying somebody $10 an hour, traditionally, like they're really paying them $10 an hour, I'm actually paying the staffing company an extra $3.50 or $4 for every hour worked. Now, normally there's a maximum of 520 hours, 3 months basically, but that's still $2,500 I'm having to pay for a temp agency. But when it comes to, so it's good and bad, right? It's good I can get somebody quick. It's bad because it's going to be more expensive. It's good if they don't work out. If they don't work out, they don't do a good job. It's just an easy calling the temporary company up and say, look, hey, this guy's not working. Just tell him not to come back. It happens. It's unfortunate. But temporary companies also, they're just expensive. They really are, and that's kind of the hesitation. But also when something's really more specialized. Company I worked previously, we made flavorings and colorings, and that was not a simple exercise. It required you'd have 2 ounces of one chemical and 3 ounces of another, and 6 of these and 5 of those. Very complicated. But what generally would happen, people, if we did have temporary associates, they didn't really learn it in time. It took, they didn't have that knowledge. So we didn't really spend a lot of time with temporary people. We mostly just kind of, just didn't use temporary associates. Third bucket, manufacturing overhead. Manufacturing overhead basically all other costs. If it's not direct labor, it's not material cost, direct material cost, but it's still part of your product. Getting it out the door, making it, it's going to be a manufacturing overhead. When I establish a sales price, I do 3 things. I add direct material plus direct labor plus manufacturing overhead. I come up with this is how much it costs me for the product, and then I'll bump it up basically 35 to 40% because I have to cover the people cost, which is usually maybe 15 or 20. This is like the SG&A part, and that still leaves me a 15% margin. Now, sometimes I might bump it up 50%, but just as far as quick and dirty math, it's kind of how we do it. As far as how much something costs, you bump it up for 50%, 45%, 60%, whatever your target is, that's what you sell it for.